Good evening, everyone. Welcome to our Kansas Alumni Association Homebuyer Workshop. My name is Jason Maida. Great to be with all of you today. I hope you're having a great start to your week, or really, this is the midpoint of the week. So hopefully everything's going well for you. Tonight, we're going to spend just about an hour together talking a little bit about home buying, kind of all the ins and outs of home buying. This is a very interactive session that we produce throughout the country to help support you on that path towards homeownership. During tonight's class, we encourage questions, so you can use either the chat feature or the Q&A feature within Zoom, and I'll be sure to answer those questions on air. Tonight's class is also being recorded, so we'll have that up on our YouTube channel tomorrow. All of the material from tonight's class we'll be sharing back out with you tomorrow morning. We've had plenty of people that have signed up for tonight's class, and some are able to join with us live tonight, but we'll be able to get all this material back out to you tomorrow. And again, we're going to record tonight's class. In case you haven't heard about APM or American Pacific Mortgage, we're the ninth largest lender in the country. Our team here in particular partners with various university alumni associations all across the country. We're excited about our partnership with Kansas alumni, and we've got a chance actually to help some of your fellow alum purchase across the country through the launching pad of our home buyer classes. And so tonight's class is going to really be spent around talking a little bit about different things around the housing market, what's going on from housing prices to interest rates and how that's affecting buying power. We're going to spend some time doing a quick budgeting exercise. You're going to see one of our website tools that kind of allows you to think a little bit more about converting from renting to buying, and then the pluses or maybe the takeaways in thinking more about those budget comparisons. We'll also take a look at building credit for home buying. What are some of the things that we should be doing as we prepare for home ownership, whether that's paying down debt or maybe challenging or maybe looking back at some of the past legacy issues we have on our credit. So we're going to kind of give you some tips and tricks around credit. We'll also look at loan programs that are available to you as first-time buyers. We'll talk specifically about some first-time buyer programs as well, but we'll kind of spotlight 5 of the core programs that generally most buyers are going to take advantage of. And then we're going to talk about savings for home ownership. That tends to be a bit of a hurdle for some buyers. So we're going to walk you through a savings plan, also prepare you with some of the documents you might need as you get ready for home ownership. And then we're going to look at first-time home buyer programs that are available. Now we'll probably look at Kansas's first-time buyer programs today, but if you are joining us from other parts of the country, we can maybe explore some of those other resources, but we'll give you a general idea of some of those tools that are available to you as first-time buyers. And then we're kind of wrap up tonight's session looking a little bit more at the buying process. So we're going to talk about, where do we go from here? So after tonight's class, you may think you want to go forward in the buying process. So we're going to walk you through the 6 steps of home buying to go from attending tonight's class to getting a consultation and being prepared with a pre-approval, all the way to the very final step of getting the keys to your house and obviously celebrating that massive financial milestone or accomplishment. So we'll walk you through the buying process as well. So a lot of great things in store for you tonight. We're really appreciative that you've decided to join us in what I'm sure is a busy schedule for you throughout the week. So thanks for taking time out to be a part of this tonight. Well, let's kind of dive in and talk about, does buying really make sense for me? So for most of us, this is probably the biggest financial decision that you're going to make. And so, most of us probably don't want to take a lot of time out of their busy schedules on a Wednesday night and listen about mortgage for an hour. But, obviously you understand how important this is and to really be informed as a consumer when you decide to take those next steps in home ownership. Now, when you think about budgeting for home ownership, this isn't going to be the same as looking at rent budget versus home ownership budget, because when we think about home ownership, there's a lot of great things that come into home ownership that you can't take advantage of when you're a renter. For example, in mortgage payments, I generally create a fixed rate payment option. So in that case, I don't have to worry about my payments changing over time, because as a renter, if your landlord wants to increase the rent, they can certainly do that, right? Whereas on mortgage, you have more of a fixed rate payment option. Now, in today's market, interest rates are at elevated levels, as many of us know in tonight's class, but down the road, interest rates will cycle lower. At that point, existing homeowners can take advantage of lower rate options and possibly improve their mortgage payment and, of course, their cash flow. Now, this is an asset that should generate equity over time. Now, what is equity? Well, equity is the difference in the market value of my home versus what I owe on my mortgage. And for most of us all across the country, that's our number one asset. So that's probably the biggest game changer when it comes to what we have in wealth for ourselves. And for most families, it does have the opportunity to create generational wealth. Now, there's still also some tax benefits that come along with owning a home. So, you can have the potential tax deductibility of interest on a mortgage, as well as if you make energy efficient upgrades to your home, that can also be potentially tax deductible. So, a lot of great things to think about when it comes to home ownership. And so I always tell clients, let's not look at this as an apples to apples comparison because there's so many great attributes of home buying that we just can't take advantage of when it comes to comparing renting. Now, one way we kind of frame this up is looking at a rent versus buying calculator. Now, this tool that I'm showing on screen here not only is going to be part of the links in your presentation slides that are coming over tomorrow morning, but this is also available on our website that you can check out. I thought I would just walk our class through just a really simple look at this calculator and some of the inputs to it, so you too can also take advantage of this resource and kind of map out your own kind of comparison to renting versus buying. And certainly during a consultation with you, we can certainly help you through that as well. But the way this calculator works is we want to take a look at, what kind of price of home am I going to buy at? How much do I think I'm going to put down? So most first-time buyers, the minimum down payment is 3% of your purchase price. And then if I finance 97% essentially of my purchase price, that puts that at 291. But then we plug in an interest rate, which average interest rate is hovering around 6.75 to maybe 6.8. And then we have the term of my loan. And so the way our calculator does is we plug in those inputs for financing. And then we say, okay, well, I think I'm going to buy my house. We just put a hypothetical July 31st, right? We put in PMI. So we're going to talk more about PMI tonight in class. But ultimately, when I put less than 20% down to buy my house, there will be what we call private mortgage insurance. And we'll spend some more time looking at that. We have homeowners insurance. We have tax rates for my home. If I'm going to buy maybe a condo, maybe a townhouse, maybe some of the communities that have a few other like resources to them, they might have HOA dues. And then our calculator also assumes some tax situations. So we have tax brackets input here for some of our assumptions. We also have costs of buying my house. So, when I own a home, right, I'm responsible for all the repair and maintenance for my house. And then our calculator that, we just did a quick little look at like a comparison of maybe looking at the next 7 years of renting versus buying. So I'm going to show you what that looks like. But we also want to assume that, hey, it's going to cost me money when I sell my home. So how much is it going to charge me for realtor commissions to sell my house? We have appreciation of our home. So we assume in this calculation that our home will appreciate about 3% on an annualized basis. And then we just have some last inputs, which would be like renter's insurance cost and, cost of rent going up over time. So here's what our calculator tells us. And by the way, we have someone that's assuming a rental position of like $1,500 a month versus trying to buy a home for say $300,000, right? So, if we look at this scenario for a buyer, after 4 years of buying, it will be cheap. Buying will be cheaper than renting after 4 years. So we can kind of do our analysis here. We can kind of move this dial here and say, okay, and I like to always kind of look at maybe like a 7-year look at things because I think that's a pretty reasonable turnover time. This one actually comes out at 8, but you can see here, this is my cost of my spend over 8 years. It becomes a profitable opportunity, meaning I'm going to be ahead on the buy side after 4 years of owning versus renting. You can see my appreciation rate, my home value going up over the next 8 years with our analysis here. But ultimately, kind of what I want to share with our class tonight is that our gain opportunity of buying versus renting over those 8 years is about $33,000. And we've achieved over $120,000 in equity in my home. Now, that's assuming the 3% equity appreciation rate. But, when we think about home ownership, I kind of kicked off with this, it's not going to be something that, well, it is going to be something that we're going to have to consider as one of our largest financial decisions. But it does change from a budget perspective. And we have to factor in all of those great attributes that come along with home ownership because it is truly not that apples to apples comparison. I would encourage our class when you have some time, you're going to get the slides tomorrow, maybe hop in there and do your own analysis. I think you'll find that to be a really great exercise to really kind of understand a little bit more about that comparison for you in your current existing budget. So that's our rent versus buying calculator. I want to now kind of transition into talking a little bit more about the housing market. Lots going on in the housing market. Every market's a little bit different across the country. Currently, right now, I think we just hit our first day of summer last week. So it's still the more active times of the year in home buying. We've kind of just transitioned out of the spring buying. Now we're in the summer buying. So most buyers that we work with are trying to figure out location of place because maybe schools are important for their family and they want to be in a certain school district. This buying season right now is really interesting because we're starting to see inventory stack up a little bit. We're starting to see more homes get on the market. Now, Kansas is a state that is not in a position where there's extra inventory or a lot of standing inventory that's been staying on the market longer. Generally, after the Memorial Day holiday, we see a lot more inventory coming to market. The four top inventory states in the country right now are Texas, it's Georgia, it's Florida, and it's also Colorado. So they have the highest level of inventories out there, which is providing opportunities for buyers to maybe exercise a little bit more negotiating power in potential properties. Now in Kansas, you can see our average days on market, 18 days, which is pretty strong. You can see kind of this uptick in prices year over year. So this is kind of a 3-year look back. Median price in Kansas, just over $300,000 and 33 homes sold year to date. So, kind of look in the Kansas market in specific is, we need a little bit more supply in the market to support buyer demand. Generally we would see more stuff come online here at this time of the year, but I think in general across the market, we need a little bit more resellers in the Kansas market. But depending on where you're located at and where you want to purchase, generally the trend is pretty positive from an increase in inventory, especially as we look at the last 2 years. Now, while we're still at higher elevated interest rate levels, buyer activity remains pretty strong. Now, the conversations I have with clients at least once a day is, should I wait until interest rates drop before I decide to enter today's market? And that can be one strategy for some buyers, but as interest rates go lower, guess what happens? Buyer demand picks up. And if there's only so much inventory to support the demand of buyers, then generally we'll see prices start to rise. So even in today's market, we're at elevated levels. Those that are financially fit have some really awesome opportunities in today's market, especially with most states across the country seeing increased inventory levels. Now, eventually interest rates will cycle lower, not really an if question, it's more of a when. And so as we look at today's interest rates, we're right around that 6.7 to 6.8 number, depending on the day in the market. This is kind of a look at the last 12 months of interest rate activity. So we're just this kind of choppy situation. When we look back at September of 24, we were all pretty excited. We're like, hey, interest rates are going lower. Everybody's excited. Maybe clients will start refinancing. That quickly changed. You can see interest rates start to vault back up. Where we're at today in interest rates still remains very volatile. The Federal Reserve has a mandate of 2% inflation. We're still at 2.4%. You're seeing a little bit of a tug of war of the administration and the Federal Reserve and trying to get them to kind of move off of the interest rate hikes that we've been in facing as a country. But ultimately, the Federal Reserve has two mandates, essentially to get 2% of inflation and also to see what the labor markets are doing in order to make a judgment call on whether they're going to cut interest rates. So there is potential that we could see a Federal Reserve interest rate cut in July. We didn't get one in June, of course. But ultimately, when we think about interest rate cuts by the Federal Reserve, that will directly impact credit cards, lines of credit, auto financing, all those things that really impact our day-to-day expenditures, right? Now, it will kind of bleed into mortgage interest rates. And we anticipate a rate cut by the Federal Reserve. We'll see interest rates start to tail down on the mortgage side. I do think we're probably going to still remain at these elevated levels throughout the duration of 2025, and then we'll start to see probably things cycle down in 26, possibly 27. Our 20-year look back of interest rates looks like this. So interest rates 20 years ago were very similar to where we are today, but of course, prices of homes were at a fraction of what they are today. And then you can see some of the major economic events. This was the housing crisis of 2008. Interest rates were a little bit lower, but certainly it was quite a lot of damage or collateral damage from the housing market. You can see this gray line here represents the pandemic. I point that out to you because, interest rates were obviously at historic lows. We saw 2.5% interest rate levels here. I get questions from clients a lot of, hey, when do you think we're going to get back to 2.5% levels? And that was certainly a one-off situation given the global pandemic, the catastrophic events that occurred. Part of that, unless we face something like that as a country, as a world, we're probably not going to see rates at that level again. The average interest rate generally hovers around 4.5% to 5% interest rates. Certainly today we're at elevated interest rate levels, but I do think we'll see things start to cycle down. Now, interest rates vary based upon a few important factors. It's based upon credit score and eligibility, the type of loan program that we're going to select, how much do I decide to finance, how much is my down payment going to be? And then as a consumer, and I get this question a lot in my day-to-day conversations with clients, is can I pay points to bring down my interest rate? And you absolutely can, but points are generally putting extra costs out of pocket in order to bring down that interest rate. A point is the equivalent of 1% of my loan amount. So if I finance, let's say $300,000, my cost is going to be $3,000 to bring down my rate on average about 0.25%. In today's market, I just don't recommend clients doing that because the break-even point for those type of cash investments is about 3 to 4 years. Most clients are probably going to consider refinancing in a couple of years. So it doesn't necessarily make a lot of sense from an investment perspective. And then the term of my loan can also influence my interest rate. So generally, the shorter my term of my loan is, and traditionally a 30-year fixed product is kind of usually the baseline option for most first-time buyers. But if we switch to a 20 or a 15-year product, that can bring down our interest rate. Now, I meet with all of our clients for video consultations. So as we build your plan for homeownership, we're going to figure out what's the right design work for you, the right term, interest rate, down payment options. So you have a complete roadmap to homeownership. And we'll talk a little bit more about that later on in tonight's class. Now, we want to kind of pivot and talk a little bit about credit. Because as we prepare for homeownership, credit inevitably is going to be one of those conversations we're going to have, whether it's the amount of obligations you have or some improvement opportunities within your credit score. Every loan program has a minimum credit score requirement, which you can see on screen. And so based upon your credit eligibility, we're going to figure out and customize which options make the most sense for you. Now, in lending, we always look at all three scores that are offered up by the agencies. So those three agencies are Experian, Equifax, and TransUnion. Each one of those agencies has a separate credit score, and they have different models that they use. Now, there are three different models to credit scoring. There's the credit card model, there's the auto financing model, and finally there's the mortgage model. Now, in our lending world, we use the mortgage model because ultimately we're providing home financing. Now we're going to talk about in today's class a little bit more about what goes into the mortgage model. We're going to spend some time looking at things like credit utilization. We're going to look at, how does the length of credit affect your credit score? In lending, we always take the middle credit score of all three agency scores. So if I have a high score of 760, let's say my middle score is 740, and then my lowest score is 720. From a lending perspective, we're going to use the 740 credit score to determine eligibility for product, interest rate offering, mortgage insurance premium, all that stuff. Now, if I decide to join forces and maybe my partner and I apply together, but my partner's slightly lower in score and I'm at, let's say my partner's 700, 680, and 660, well, the 680 score is the lowest middle score between both of us. So that 680 score is what would be used from a qualifying perspective. Now, in credit reporting, there are different things that will appear on your credit report, or I should say, different historical factors that will show up on your credit report, and they will remain on your credit report for various lengths of time. Things like hard inquiries will be on your credit report for 2 years. However, the impact to your credit score is in the most recent 6 to 12 months. Other important events that could be, legacy items on your credit report, like a bankruptcy or late payments, can be on the report for 7 years, but the impact to the score is in the most recent 12 to 24 months. Okay, let's dive in a little bit deeper into the FICO score calculation for mortgage. So as I mentioned, we have the three agencies reporting. Each one of them have a mortgage model. You are going to see different scores between the different agencies. So that's just what it's going to look like. And many of you that use the monitoring systems like maybe Credit Karma or some of the agency systems, you are in fact going to see a lower or a different credit score between those monitoring systems. versus what we might appear on a mortgage score. Now, one of the things just to point out to you, when we meet with you for a consultation to design your home buying plan, we only do a soft credit check. The reason why we do that is because we don't want to impact a client's credit score, especially as they're preparing for home ownership. We want to make sure that we can design a plan for you without putting a hard inquiry on your score, which could, or on your report, which could actually lower your credit score. So let's look at the weighting of the credit score. 15% is going to be how long have I had credit. So the more mature my credit file is, the higher my credit score is potentially going to be. So if I have credit length of history for like 6 months, if I compare that to someone that has history for the last 6 years, then that 6-year history is probably going to score a little bit higher. 20% is going to be how much new credit am I trying to open up? So if I'm opening up new accounts, if I have a lot of new inquiries, that is going to have a 20% impact to my credit score, especially again in the most recent 12 to 24 months. I really want to avoid opening up new credit accounts. And then the amount I owe, which is also known as credit utilization. So in credit utilization, we're looking at revolving credit card accounts or revolving accounts in general versus what my balance is owed. So if I have $10,000 in credit limits and let's say I have $5,000 in balances, right now I'm at 50% utilization of credit. Ideally, I want to have that credit utilization at 10% or less, so $1,000 or less, right? Now, here's my tip for you in managing credit card debt. If you take a look at one of your credit card accounts, for example, there's two important dates. One is the due date, which we're all very familiar with. The other is the billing statement date, which basically tells us when all of the credit activity has now closed out. So when that credit date or that billing cycle date hits, the credit card issuer sends out all your important account information to the 3 agencies. My tip for you tonight is if you can change your approach in paying that bill before your billing cycle date ends versus paying on the due date, what you're going to do is you're going to be able to pull down that balance lower before the reporting goes out to the agencies, therefore increasing your available credit, lowering your utilization, and then potentially having a higher credit score. The other component of the weighting is payment history. That's obviously pretty self-explanatory. How have I paid my bills? If I've had any past challenges, it's going to be looked at in the most recent 12 to 24 months. If you have late payments, they're rated as 30-day lates, 60-day lates, and then 90-plus day delinquencies. The bigger the day of delinquency, the bigger impact I'm going to have to my credit score. All right. Now, before I dive into student loans, I just want to check with our group, take a quick pulse check here. Any questions so far from our audience before we move in and talk a little bit about student loans? And you can use either the Q&A within Zoom or, like I said, you can use the chat feature, and I got both windows up, so I'll be able to check those out for you guys. Okay. Let's talk a little bit about student loans. That's a topic of conversation as I work with clients. Now, most of the federal student loans that I see are starting to come back online with payments. And so when we look at the calculation that we use in lending for what those minimum payments are going to be, if you're in active repayment and let's say you're on an income-based repayment program, we can use that payment right away. So if I owe $75,000 worth of student loan debt, I'm paying $250 a month in maybe an income-based reduced payment option, then I can use the $250 payment as my qualifying payment. Now, let's say I'm applying for an FHA loan and I'm in deferment because I'm back in school, or maybe I'm still in forbearance and I don't start repayment until December. Then I have to use 0.5% of that $75,000 in debt, which would be $375 per month, to calculate your expenses. On a conventional loan, it's a little bit higher. It's 1% of the balances. And of course, that would be $750 that we would use into calculating. So, the takeaway here as it relates to student loans is that, the active repayment status is really important. If you're in deferment or forbearance, we're going to have to use those default calculations unless you kind of activate your repayment schedule. And so that's kind of what it looks like from a student loan perspective. The reason why we do that is because every loan program that we work with for our buyers includes underwriting guidelines that ultimately shape how we have to qualify clients. And so we now want to talk a little bit about loan programs that are available to you as a buyer. And so I want to spend some time giving you just a high level look at each one of these programs. We'll dive into the first one, which is a conventional home loan. You may have heard about a conventional home loan because that terminology of Fannie Mae and Freddie Mac is in the news actually quite a bit as of late, just because they're talking about maybe privatizing Fannie Mae and Freddie Mac. Right now, they're under conservatorship by the US government, especially during the housing crisis. They kind of brought Fannie Mae and Freddie Mac into the fold. And so now you're starting to see both of those agencies profitable. And so there's conversations around privatizing them. Fannie Mae and Freddie Mac occupy about 60% to 70% maybe of all the originated loans across the country. The conventional loan has a minimum down payment of 3%, minimum credit score of 620. And every year around October, there's a conforming loan limit that's set. Today it's 806,500 all across the country. So for every market across the country, a first-time buyer can put as little as 3% down and while financing 806,500. The next product is an FHA home loan. That stands for the Federal Housing Administration Loan. That is a government insured loan, has a minimum down payment of 3.5% with a minimum credit score of 580. Now, the maximum loan amount for FHA will vary based upon what part of the country and county that you're going to buy in. Now, I want to turn your attention to not only just the FHA loan, but the USDA loan. So these are both government insured loans. USDA stands for the United States Department of Agriculture. The reason why I want to kind of bring these two products up together, because they are both government insured loans, there were some underwriting guideline changes in May as it relates to residency within the United States. So recently there was changes made by FHFA that basically states that no longer can you be a non-permanent resident to access those products. So you have to be a permanent resident for any type of government insured products. Now, at the same time, conventional loans still recognizes non-permanent residents for eligibility in programs, but those changes just on government insured loans was announced in May. Now, just to kind of expand a little bit further on the USDA product, that is a zero down payment option. It's for clients that want to buy in more rural areas, minimum credit score of 620. Advantage there is it really has a zero down payment option, but there is two qualifiers to that program. It's about the location of the property. It has to be in a rural area, and they do look at income based upon the household size. Jumbo loan is another product, not really typical for first-time buyers. Higher down payment options, usually 10 to 15%. It's really for clients that are going to try to buy at higher price levels. So we see that more in our higher cost of living markets. The VA home loan is for our veterans that have eligibility for the VA home loan. Great product to support our veterans' entry to home ownership. Zero down payment option. There really is no maximum loan amount to the VA product. In fact, at APM, we can go here as high as $5 million in loan amount. And it is reserved for veterans. Now, if a veteran does have any partial disability, there's what we call as a VA funding fee that is completely waived for the veteran. Generally, the first-time users of the VA loan will pay a 2.3% VA funding fee, and that gets factored into the total balance of financing. Okay, moving on, I want to talk a little bit about PMI or private mortgage insurance. I kind of alluded to this a little bit when we first started tonight's class. PMI stands for private mortgage insurance, and what PMI does is it essentially insures the lender against default by the consumer in case something happened in the economic situation for the owner. Now, there are two forms of mortgage insurance. So PMI is private mortgage insurance, and then there's MIP or mortgage insurance premium, which falls under a government insured loan. So if we jump back over to the conventional loan, PMI is broken down or calculated, I should say, based upon a few important factors. We look at what the credit score is for the buyer, the down payment, and how much they finance. And so based upon those risk factors, we come up with a monthly premium. Now, if you've already started home searching on Redfin or Zillow, you're probably going to notice some pretty high premiums on PMI. So what I found in working with buyers across the market is that, those numbers aren't necessarily accurate because they don't have those characteristics built into most of the calculators that you see on those sites. Now, one of the advantages to a conventional PMI program is it does have a cancellation option. So once I have 2 years in the loan and 20 to 22% equity, I can apply to have the mortgage insurance canceled. So on a conventional PMI loan, let's say I have $300,000 with my amount financed, I'm putting 3% down. My PMI is going to be about $92 a month. Okay, now the higher I can elevate my credit score, maybe the higher I can elevate my down payment, the less expensive that cost of mortgage insurance will be. Now, transitioning over to more of the FHA side of things, with mortgage insurance around FHA, there's two forms of mortgage insurance. There's monthly mortgage insurance, which is calculated at 0.55% of my loan amount. And then we divide that by 12 to figure out the dollar figure on a monthly basis. And then there's upfront mortgage insurance, which is added on 1.75% of my loan amount. And so that gets financed in. And so it tends to make the FHA product a little bit more expensive than what we see on the conventional side of things. Now, FHA loans have no cancellation options for mortgage insurance. So once I reach that 22% equity, I'm going to have to kind of figure out maybe it makes sense for me to refinance, and then maybe I can transition over to more of a conventional product. I don't look at the FHA loan as a long-term solution for our buyers. It's more of an entry point to homeownership because FHA has a lot more flexibility when it comes to credit score minimums or when it comes to leniency around maybe past credit challenges. FHA is going to give us a little bit more flexibility than what we see on the conventional side. If we run our same $300,000 loan amount calculation on FHA, we have that upfront mortgage insurance of $5,250 that gets included into the total amount financed. And then we have monthly mortgage insurance, which is $137 per month. And so, the numbers are a little bit higher, of course, on the FHA side, but I kind of go back to my earlier point. FHA is going to be a little bit more flexible for buyers in their qualifying for homeownership. Now, one of the things that we examine in designing options for clients is we take a look at income when it comes to their home purchase, because we do have an analysis of looking at income versus expenses. We have to have enough income to support what the new house payment is going to be, as well as expenses. And we're going to talk a little bit more about that calculation in just a minute. I wanted to provide you with a quick list of documents that are generally needed as we take those next steps in homeownership. And then I want to talk to you a little bit about some different scenarios around income. So generally, we have to verify the last 2 years of work and or educational history. So we don't necessarily have to be on our job, 2 years to qualify for a mortgage. It can be as little as a month, and we can still be eligible for financing. So as long as I can support my educational history and or work history, that's what I need to meet the 2-year qualifying requirement. Now, if I'm self-employed or like independent contractor, I do have to show that I've been filing taxes for the last 2 years in order to be eligible for financing. That 2-year rule also holds true for clients that have multiple jobs. So let's say I'm working for one employer for 30 hours a week, another employer for 20 hours a week. I have to show or demonstrate that I've been working with both of those employers for the last 2 years in order to have both sources of income included into my qualifying calculations. All right. Now, we also have at times clients that are working multiple jobs or have multiple jobs that are maybe 1099. So let's say I work 40 hours a week at my job, but I also drive for Uber on the side on weekends. We can introduce that Uber income for qualifying, but we have to show that we've been doing both the 40-hour work week job and the Uber work simultaneously for the last 2 years. Now, one of the last things that I wanted to or a couple more things I want to cover in the income section. I get a lot of questions from clients around new jobs or transitioning to a new job. So we can use new employment opportunities right away as long as we have a fully executed offer letter. In fact, in some cases, you don't even have to start that job to be able to determine if that we can use that income. If you have a job that you're starting on, let's say September 1, and you have a fully executed offer letter and you're ready to go, you can still potentially purchase your home today using that offer letter. And the last thing I want to talk about in income is just around other sources of income that you may want to use in your home buying scenario. So if I have, let's say, a partner that contributes to my household, but they're not going to be on the application, then unfortunately I can't use that income from a qualifying perspective. So any income we need or we have from additional parties, they would have to be introduced as an applicant on the loan. Even if I have border income or rent income from maybe a roommate that's helping me out, I can't include that into the qualifying unless we're electing a program that allows room rents to be factored into the income calculation. All right, so that gives you kind of a little bit of an idea about income. We also look at income versus expenses. We call that our debt to income ratio calculation. Really simple approach to figuring out qualifying, but ultimately we're looking at credit card debts, personal loans, student loans, auto loans, anything you can think of that would generally appear on the credit report. And then we also add in the projected housing expense as well. So things like principal and interest of my home mortgage, what the property taxes are on my house, homeowners insurance, mortgage insurance if I'm going to pay it, maybe even the HOA expense if I'm buying maybe a condo or townhouse. So we add those into our equation, then we divide it by the total gross monthly income, and then it gives us a percentage that we use to determine eligibility. Now, that percentage generally recommends that we would want to stay between 33 to 36% of our income going out to those expenses. The guidelines in lending will allow us to go to 45, even 50%. That's obviously on the high side because ultimately, when we think about what our net income is, that's what we're certainly budgeting off of, not necessarily pre-tax income. So it's something we obviously talk to our clients about. It's really important to design options for you around homeownership that are affordable and sustainable over time if there's any bumps in the road economically. And so what I found in working with clients is that generally when their expenses are somewhere around 36% or less, so I'd say 33 to 36%, that feels like it's a pretty good comfort zone for most clients to feel like, hey, I'm going to be secure in my home and I can afford my payments on a monthly basis. Okay, the last thing we want to talk about before we dive into the workflow of owning a home is to talk about down payment and first-time home buyer programs. The reality is down payment options or resources can be really scarce for some of us as we're trying to prepare for home ownership. Now, we can certainly save up, and we're going to talk to you a little bit about savings plan, but we can also look at other resources like investment vehicles that we can access for home ownership, as well as gift funds. Checking in savings accounts that we use, we have to verify the last 60 days of transactions in those accounts. So we can't have any cash accounts that are used or cash transactions used in a home purchase. Retirement accounts like 401ks, 403bs can potentially be used in financing. We would generally ask that you talk to your administrator of your 401k or maybe your investment advisor before you access those assets. And of course, brokerage accounts can be used as well. But we want to make sure that we talk to tax advisors so we're not creating a tax event for yourself. Gift funds can be also used in a purchase transaction. That's where a family member is contributing to our out-of-pocket expense to purchase a home. In that case, with gift funds, there are no seasoning requirements for that. We just have to document a gift letter as well as the receipt of the funds from the donor. Now, in homeownership, like I said, savings can be a little bit of a challenge. And so as I get a chance to work with clients across the country and develop plans for them, we talk a little bit about an approach to savings. We call that a savings plan, essentially, which takes a look at, what can I expect that I can afford on a monthly basis for homeownership? And then how can I build that into a rapid savings plan for myself? So let's say, for example, I'm today paying $1,500 a month in rent, but after consulting with us, I feel like I can make my mortgage payment work at $3,000 a month. So I have an uptick of $1,500 in outgoing debt when I ultimately purchase my house. But today I'm lacking the savings that I need to achieve homeownership. So what I would tell a client is, let's start making savings happen today like we're actually paying that $3,000 mortgage payment. So on the first of the month, when I pay my landlord the $1,500 that I have for my apartment, I get in that habit or rhythm of taking the additional $1,500 and transferring it right over to my savings account. So as I do that, I'm generating savings on a monthly basis. By the end of 6 months, I have $9,000 accrued. By the end of a year, maybe $18,000. And that certainly stacks up when you compound interest that are available in high yield accounts. So that can really add up quickly. And it also helps you transition to homeownership a lot easier. So it's not such a payment shock when it comes to moving from renting a house or apartment to owning a house or or owning a condo or townhouse, whatever the case may be. So that's a really simple approach to savings that we would encourage you to think more about as you're preparing for home ownership. Now, there are some assistance programs available all across the country. So generally every state has what we call an HFA or housing finance agency. They're designed to support low to moderate income households in home ownership. We're an approved lender with the Kansas Housing Resource Corp. So that program provides anywhere between 15 to 20% assistance for down payment as well as closing costs. What essentially that is, that's a zero interest loan that can be forgiven after 10 years, but it's only available in certain parts of Kansas. So, if you're going to meet with us for a consultation, we'll talk about, where you want to buy and see if there's some applicable options for you there. There are other Kansas assistance programs that can help with anywhere between 3 to 5% of your sales price as well too. We do have a nationally branded program too called our Pathway DPA program. It will assist on an FHA loan of anywhere between 3.5 to 5% in assistance funds. But like I said, depending on where you're joining us at and what part of the country, there's probably some type of housing agency designed to support low to moderate income households. So low income housing, just so you understand, is less than 80% of the median income. Moderate income households generally are somewhere between 100 to 120% of median income. You do have other states that recognize moderate income, like California, for example, as 150% of the median income. All right, let's talk a little bit about the buying process. Where do I go from here after tonight's class? Now, hopefully one of your next stops after tonight's class will be to connect with me for a consultation. I'm going to give you some next steps on how to do that. It's a free service that we provide in our communities to help support you in plan in homeownership. Now, where we go from there is this path towards homeownership, which is our 6 steps of home buying. Step 1 is to get pre-approved for your housing options. That comes out of that session that we do together for your free consultation. A pre-approval is usually good for 60 days, but we can always update that pre-approval. Your application stays live with us for 2 years, so there really is no hurry to go out and shop for homes, but we just want to make sure you're fully prepared that when you do find that home of your dreams, that you can act quickly because you'll be fully pre-approved. Now, to find that home, you obviously have to start your home search, right? So it generally starts online and then it eventually transitions to in person. That will be step 2 in the process. We encourage you to connect with a local realtor that should be a subject matter expert in whatever community that you're looking at. If you do need the recommendation of one of our preferred realtors that we've worked with on previous transactions, we can certainly get you connected. But a realtor in your market should be experts in the home search, negotiating power, having connections with things like home inspectors and insurance companies that can really help support you on that journey towards home ownership. So as we're in that step 2 process, you're going to be looking for homes. Let's say we find the home that we love and we're going to make an offer on that house. Well, if we make an offer on that home, let's say that offer gets accepted, then we're going to move to step 3. And that step 3 is called entering escrow. So that means we've come together, buyer and seller. We now have a ratified contract. And now we're going to start the process of the escrow timing. Now, generally, most contracts will take 30 days. So from day 1 to day 30, when I get the keys, this is the process we're looking at, which basically runs from step 3 to step 6. That day that your offer is accepted, whoops, we lost some lighting here. Hold on a second. There we go. That day that we get your offer accepted, you're going to get a call from me just congratulating you on your accepted offer and kind of give you a sense of what the timeline looks like for your home purchase. Now, inside of a contract, there's going to be obligations for you as a buyer, like, for example, the deposit of an earnest money deposit, which is generally 1 to 2% of your sales price, but that does get counted towards your total out-of-pocket expense. And we have a kind of a slide here that references that as well. That money is generally protected in escrow by what we call the contingency in most parts of the country, which essentially gives you time as a buyer to do your homework on the property. Like, let's get the house appraised. Let's make sure the home value supports the buying price that I'm going to be at. Let's get the house inspected to make sure there's no, termite issues or, leaks that we need to investigate further. And then let's get our loan approved. And that's, of course, where our APM team will come in to make sure your loan is swiftly approved. And that starts us now down to step 4, which is going to be the processing and the underwriting of the loan, where we're verifying employment, your assets, we're making sure the loan structure is set up correctly, and just making sure we have everything sound for you. Now, let me kind of step back for a second. At step 3, when you do go under contract with the seller, you are going to get a call from me congratulating you on your accepted offer. We also schedule you for a follow-up video session once you go under contract. That is kind of the next video session we've done after your pre-approval and certainly after you find your home. That's when we go through all the design work of you and your financing. I meet with all of our clients that not only get pre-approved with us, but those that are under contract with sellers. All right. Now, step 5 is going to take us to a good portion of the way down the runway of home buying, which is the loan approval phase. That's where your loan has been approved by an underwriter. They've reviewed all your income, assets, and your credit, make sure the product type is set up correctly. You, by that time, have already got your inspections back on the house. You've gotten your appraisal back to support the value. And at that time, you'll have the option to sign off on your contingencies with the seller, which tells the seller that you're ready to move to the final stages of the process. Now, before we do that, we have to send out to you a final closing disclosure, which gives you a 3-day cooling off period before we get to that very final milestone. Now, throughout the process, our disclosure system delivers disclosures to you electronically, and that's kind of set out through different milestones in the process. So you're going to get initial disclosures within 72 hours of your accepted offer. Once we lock in your interest rate, you get another set of disclosures. And then at step 5, you get your final closing disclosure. All of those different disclosure sets should all align with each other. Now that's all done electronically, but step 6, we start getting into the in-person phase. You're going to be signing final loan documents with an attorney or maybe a public notary or an escrow officer, depending on what state you're in. That process takes about an hour or so. That same day, you also deliver your final funds to escrow for your home purchase. As your lender, I'm going to wire in the final funds for your home financing that same day. And then documents get recorded with the county recorder's office that day. They usually record a instrument that's the grant deed to transfer ownership, as well as the deed for your loan, and that tells you the repayment terms of your loan. Those items get confirmed with the county recorder's office, and then we get a chance to make our favorite call of the day and say, hey, congratulations, you're now a new homeowner. I made 2 of those calls today for some of our other markets across the country, and it's just a great day for our clients. They're so excited to get a chance to fire up that moving truck and get the keys to their house. I mean, it's a joyous day for sure. And of course, we would love to be that partner for you to help you on that journey as well. Now, for those clients that close today, our relationship doesn't stop with them, because part of our aftercare is monitoring market rates and see what things are doing, because they may have an opportunity to refinance down the road to improve their overall cash flow on their mortgage payment. So that's some of the things we do in our aftercare program. We're tracking clients' home equity to make sure they're well positioned financially, and we're always checking in with our clients on an annual basis just to make sure we're here for them as a resource in case something changes for them financially. Okay, that's kind of what the buying process looks like. Now, as we think about next steps from tonight's class, we'd love to be able to get connected with you for a free video consultation. That's what I spend most of my days doing, designing plans for clients if I'm not teaching classes throughout the country. This is a 30-minute session we do with you. It's a really simple get started process. There's an online application. We only do a soft credit check, and then you'll upload documents and then schedule a convenient time that works good for you using our scheduling system. I've provided all the links here on this slide. Now, if you do have some questions after tonight's class, I know we haven't got many questions tonight, but if you do have some questions, maybe a specific scenario you'd like to talk to myself or our team about, we have our introductory phone call option as well too, but you can find these on our website. Our scheduling system is pretty user friendly, and we'd love to be able to obviously connect with you. This is what a consultation looks like for you. Just designing a roadmap, essentially, like understanding a little bit more about where do you want to buy, what's your timeline look like. Should we look at some assistance programs? Is there some coaching opportunities from a credit perspective that we can help you with, or just looking together at like savings plans for homeownership? All those important things to create the framework for you on that path towards homeownership. Now, as I wrap up tonight's class, I just want to point out one of our technology features. It's our mobile resources. You can start the buying process right from mobile. But I think beyond that, the calculator is a great feature of mobile. You can chart, follow the course of your loan once you're under contract with the seller. So we really embrace technology, but it certainly doesn't replace the human touch in the process. So we really make sure that we're available to our clients, whether that's email, phone, video, because we understand this is obviously a big, big financial decision for you. Well, we're wrapping up tonight's session, but I just want to point out to you, because of our partnership with KU Alum, we provide also a discount in services. So not only are we going to try to get the best possible product for you, but we also discount our services for you with a $750 closing cost discount. Obviously, we have our classes that are available to you. These are 4 classes that we teach throughout the year on a quarterly basis. You're always more than welcome to attend these classes. They are free for our community. And so if you have friends, family, maybe coworkers that would also like to attend these classes, we also have some of our other partnerships listed on screen. So feel free to have them come check out some of those classes. We record every one of our classes, which you can find up on our YouTube channel. We've actually provided all of our social channels down here. And we would encourage you to follow us on Instagram and see what we're doing, because ultimately we've tried to provide good resources for you. So after today's class, you want to learn a little bit more about all these things that are happening in the housing market, or resources that are just coming online as availability for you. Feel free to check us out. You can follow us at JMeda Mortgage. And this is all my contact information here. So feel free to reach out. Any questions you do have, I want to make sure that I'm here for you as a resource. All right. Well, I appreciate you attending tonight's class. I understand, there's a lot of different things you could do on a Wednesday night, but thank you so much for your attention. Want to stick around a little bit. I think most of you still are online. So if you do have any questions, you can drop those in the chat or the Q&A, and I'll answer those questions for you on air. So feel free to put any questions you have. And if you don't, that's okay too. We'll make sure that we answer any follow-up questions that come from the group after tonight's session. Okay. Unless somebody's typing away feverishly there, I think we're good. I hope everyone has a great rest of your week. I do hope I get a chance to connect with each of you to help you on your path towards homeownership, whether that's this year, next year, or beyond. We just want to make sure that we're a resource for you. Have a wonderful evening. I'll look forward to seeing you all soon. Have a good night.